If you've been trading for some time, you must have heard about Mark Douglas. He's one of the most popular traders and a true icon in the trading community. He's also the author of a couple of courses and a couple of books, mostly focused on trading psychology. So in this video, I want to go over the main lessons I learned through his teachings, through reading his books, and the ones that you should know about. Before we dive deep into this, there's going to be a link in the description to tradersmarket.io where we publish all the trading tools we make, so check it out. So as I said, in today's video, we're going to go over 3 very important ideas from Mark Douglas that you must know. So the lesson or the idea number 1, every individual trade outcome is completely random. And here's what I mean by this. Let's say you are flipping a coin. As we know, there is a 50% chance of getting, like, this is gonna be head and this is gonna be tails, okay? There's a 50% chance for one or another. What many people would think is that if I flip the coin, I get head, and then I flip it again, I would be expecting to get tails, because then it would be 50-50. But actually, each time that you flip a coin, there is a new 50-50% chance that it's going to be one or another. But if you would do it 1,000 times, then most probably 50% of the flips would be head, and then 50 would be tails. So what does this teach us about trading and our trading system? This means that each trade is a random outcome, and when I say random, it's going to be dependent on the win rate of your strategy. So let's say you have a strategy with 70% win rate. That doesn't really mean that you're going to have 7 winners and you're going to have then 3 losers, and then you have 7 winners and you have 3 losers. What can happen is that you have 70 winners and then you have 30 losers, which is good. But another thing which can happen, which is a lot worse, is that you have 30 losers and you're gonna have 70 winners later on. I mean, all of these situations are very rare, and these are the extremes that I'm talking about, but generally this can happen. And this is very important to understand, because then it doesn't mean that the one losing trade is actually killing your system. Actually, each trade is a random outcome, and it is dependent on your win rate. So the wrong conclusion that you can make is like lost trade is equals bad strategy. What you should actually understand is that you need a series of trades to see the edge. So again, as I said, like, you can have a 70% win rate and you can have 5, you can have 10 losing trades. I mean, it's gonna be a lot less likely that that's gonna happen, but you need to expect losses, and the distribution is gonna be random. So this is very important to know. So each time you look at a trade, you don't look at it like, okay, here is a lost trade, or here are a couple of lost trades according to my win rate. This should never happen. Actually, it can happen, and it most probably will. So don't get discouraged. You need a series of trades to see the edge. And this is why you need to leave your bots running when you deploy them, and not like, turn them off after one losing trade. Or if you don't trade with trading bots, if you trade manually, you see one losing trade, 2, 3, and you stop the strategy. Like, you need to expect losses. Lesson number 2 is more of orientation to risk to reward. It says that a 40% win rate can outperform a 70% win rate. How? Well, because of the concept called risk to reward. No matter what you're trading, is it for FX, stocks, commodities, metals, anything, you are probably thinking about, and you have a very strictly defined risk to reward. So a risk to reward is basically, I enter here, okay, so this is my entry. If price goes to target here, this is my target or my take profit, then I take all my money, I close the position, and here, if it comes to here, this is my stop loss, then I close my trade. If this is equal distance, then it means it's a 1-to-1 risk, which is to the stop loss, to reward. Now, if you have 1-to-1, that means one losing trade equals one winning trade, so it's very easy for calculation. But if you have, let's say, 1 to 4, that means that one winning trade can actually cover 4 of your losses. And this is very important to understand. So as it says here, what can happen is, like, let's say your average winner is like $80, but your average loser is $200. So if you have a 70% win rate, you're actually not making money. You are, on average, you're losing this much per trade. On the other hand, if you have 40% wins, which looks a lot worse, but you have an average winner of $300 and a loser of $100, then your expectancy is $60 per trade. So it's very important to look at risk to reward no matter what you're doing, like whatever you're trading, and almost in any strategy you should be aiming to have a good risk to reward. Risk to rewards which are lower than 1 to 1 can work only in like highest win rates, because what can happen is exactly what I described here. So for example, some people have 1 to 0.5. So this means that you need 2 winning trades to cover 1 loss that you have. So again, this is much harder to trade. You need to have a crazy win rate to actually make this kind of strategy profitable. It is possible, but it's very hard. So look at it more from the perspective to try to get as high risk rewards. I mean, again, realistic, like not 1 to 20, 1 to 50 or some crazy stuff like that, but 1 to 3, 1 to 4, 1 to 5. These are the ones you should be aiming for. And the third one is most traders don't have a strategy problem. They have an execution problem. And actually here are 2 lessons that I want to point out. The execution problem, we're going to talk about that, but one is that you don't have a strategy problem. And this is very interesting because Mark Douglas was actually talking about most basic strategies all the time. So he was like, I don't care what strategy you're trading. If you're trading like, I don't know, he was putting stochastics, and he was like, this is a great strategy. Win rate is 60%. That's all we need. 60% win rate is an edge. And we don't need like 1 to 1 risk to rewards, I think it was, or 1 to 2, something like that. And he was like, this is an edge and I don't need anything more than this. And now we work on psychology. So he was very little focused on the strategy. He was a lot more focused on the execution. So really, when you are thinking, and questioning your strategy, actually question everything around it, because your strategy, if it is, if it captures some market movement, meaning it tries to understand like the inner mechanics, like you're not buying and selling randomly, you actually are using some indicators on a solidly, high time frame and stuff like that, and you have good risk rewards and you have an edge, then you're probably good. You do not have to reinvent the wheel. You are probably good with your strategy. You can do better, probably, but again, a lot of the time your strategy is not the problem. So, as he said, execution is the problem a lot of the times. Hence, why we like our trading bots. So, the 3 ways that execution breaks down. This is important to understand, especially if you're trading manually. So, first one is hesitation. The setup fires, but you wait. You're not sure, you're still thinking about it. The other one is overtrading. Overtrading can happen, due to emotions, due to just not having a plan, and stuff like that. That's the second way your execution of your strategy, and when I say your strategy, I mean even broader, like your trading plan, breaks. And the third one is the one I think very interesting for most of you guys, and it is mid-trade rule changes. So this is something I think we all did at some point. It's like you have a setup, prices are moving, and then you're looking at it, you kind of have the setup, but maybe you're not really sure. So according to your strategy, you don't have it, but it really looks like the one that you want to be trading. Maybe it's some engulfing, but you don't have the EMA crossover yet, or you have the crossover, but you don't have the engulfing and stuff like that. And then mid-trade, you change your rules. And you're like, no, I'm gonna enter, I'm so sure. And then you lose money. Or even worse, you make some money. So now you have a situation where you made money when you change the rule. So the issue with this is then you're gonna do it again and again and again, and a lot more than you should. You're gonna be losing money more than making money. So you should stick to your strategy, your set of rules, and you should not change it, especially not mid-trade. Like for example, some people like, open a trade according to the rules, but then during the trade, you're like, what do I do? Do I close it here? Do I wait more? Do I wait for the 1 to 3 risk to reward that I decided to? Do I take the profits at 1 to 1 because I need them or I want them? Stuff like that. Like, you need to be following your trading plan and your strategy. So these are like the 3 main mistakes that the traders make when trading manually. That would be it from lessons from Mark Douglas. Again, he's really someone you should be studying and reading his books. The 2 most popular ones are Trading in the Zone and The Disciplined Trader. I recommend reading both of them. They're really, iconic books, so definitely check them out. So that would be it for this video. If you want to help yourself with the actual execution problem, then we have developed a bunch of trading tools, the trading bots. For 90% of the strategies out there, we have automated them at tradersmarket.io, so feel free to check out the link in the description. One more time, thanks for watching, like, share, and subscribe, and see you in the next video.